Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
Hello, I'd like to talk to you today about investment risk, your attitude to investment risk, and why it really matters. What we've done over the years is we've monitored the investment performance of our clients' investments on our preferred investment platform called Byrne. And what we've done is we've devised a 10-year graph of past performance based on differences in each client's attitude to investment risk. Now, to give you an example, we do it on a scale of 1 to 10. So investment risk grade 1 means you're very, very low risk. Investment grade 5 out of 10 means you're medium risk. And if you have an investment grade of 10 out of 10, that means you're very high risk. Now, if you can just picture a graph, and you can see 3 lines on that graph from left to right. The first line doesn't go up very much. It goes in a fairly straight, upward, modest climb. That's called your low risk attitude to investment risk. The next line is a bit more zigzaggy and it ends up higher. That's your medium attitude to investment risk. And the third line on the graph from left to right is very zigzaggy, but it ends up much higher at the end. Well, each one of those represents an investment return based on investing in a mixture of asset classes, we call them. And each of the asset classes, the 4 classic asset classes, are cash, shares, otherwise known as equities, bonds, by which I mean corporate bonds or government stocks, and fourth is property, meaning commercial property. In other words, warehouses, offices, retail units, that kind of thing. So 4 asset classes, just to repeat: cash, shares, bonds and property. Now, what we do for clients is we invest their money based on their attitude to investment risk. So if you have low attitude to investment risk, we would put a lot less in shares, a lot more into cash, bonds and property. And likewise, if you're a high risk investor, we'd put a lot more into shares and a lot less into cash, bonds and property, because they're deemed to be low risk investments. So by spreading your money invested around all 4 main asset classes, you're basically not putting all your eggs in one basket. And what history has shown, that over periods of 10 years, you beat all other asset classes by investing in shares 90% of the time. Over longer periods than that, say 15, 20 years, it's more like 100% of the time you get better returns from shares. But remember that graph I asked you to imagine in your mind earlier. Remember, the highest attitude to investment risk, the investment returns go up and down the most, they zigzag up and down the most, and that gives you a more risky experience, which you may not like. You may not be able to sleep at night by doing that. So most people, human nature, tend to opt for medium risk, so the price doesn't rise and fall too much, and that's a very healthy mixture of cash, shares, bonds and property. Now, I mentioned earlier that we do have our favoured investment platform, Byrne. Byrne is a very good company. They are owned by Aberdeen Standard, which was a merger of Aberdeen Asset Managers and Standard Life a year or 2 back. It's a FTSE 100 share quoted company. They're very strong. Byrne has a very nice series of investment strategies, one of which we really like, called the Strategic Passive Strategy. Each strategy consists of typically 12 to 15 funds. So let's assume the Byrne Strategic Passive Strategy is invested in 15 funds at the moment. Each fund is managed by a fund manager. Each fund manager in turn will invest in typically 40 to 50 shares. As a result, if you have 15 funds with 15 different fund management groups, each one of them has the £85,000 investor compensation available, much like you get for a bank or building society account. Now, so if you multiply 15 funds by £85,000, that gives you a sum total of £2.55 million. So what this means is that if you were to invest, say, £2.5 million into this strategy with us, if all of the fund managers failed, you'd get all your money back. Now, I think that's quite a good deal, and it just goes to show how you can really manage your risk substantially by using a strategy like this, and by spreading the risk amongst all the asset classes, and by maximising your use of the investor compensation scheme, which you wouldn't get if you just invested with one fund manager or one company. So as a result, it's very important to get your attitude to investment risk right, and don't have all your eggs in one basket. Happy investing.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.